Hello, everyone, and welcome to Financial Accounting. Today, we're going to look at end of the month adjustment process. Adjustments are necessary to match revenues and expenses. The idea of matching concept is that when revenues are earned and recorded, all expenses incurred in generating the revenue must also be recorded in the same accounting period. The adjustment process completes the information necessary for financial statements preparation. Keep in mind that if all of company's transactions are in cash, no adjustments are necessary. We only need to record adjustments when cash received or paid, after revenues are earned or expenses are incurred. Deferrals are created by recording a transaction in a way that delays the recognition of an expense or revenue. Common examples include prepaid expenses and unearned revenues. Prepaid expenses are recorded as an increase in assets because it is a future benefit and an increase in expenses. For example, prepaid rent is a prepaid expense for a tenant. Prepaid insurance is also a good example of prepaid expenses. The amount is initially recorded as an asset, but becomes an expense over time. Unearned or deferred revenues are revenues for which cash is collected in advance of revenue actually being earned. For example, an extended warranty paid by a customer when a product is purchased is an example of deferred revenue for a seller because cash is already received, but services will be provided in the future. Deferred revenue is recorded as an increase in liability and an increase in cash. Deferred revenue will not be recognized as revenue until it is earned. Accruals are created when revenue or expense has been earned or incurred, but hasn't been recorded at the end of an accounting period. Common examples include accrued expenses or accrued revenues. Accrued expenses or liabilities are expenses that have been incurred but are not recorded in the accounts. An example would be wages incurred during the month but are unpaid on the last day of the month. Accrued revenues are assets or revenues earned but not yet invoiced. An example would be a revenue for patient services earned but not yet billed to the insurance companies. Now let's look at several adjusting entries. To get a better understanding, I would recommend that you first review transactions in the video called How to Use Accrual Concepts of Accounting. The link to the video is in the upper right corner. On November 1st, the business had paid a $2,400 premium for a 2-year business insurance policy and a $6,000 premium for a 6-month malpractice policy. During November, a portion of the prepaid insurance purchased has expired. Since the business insurance is a 2-year policy, it is expiring at a rate of $100 per month. The malpractice premium expires at a rate of $1,000 per month. A total of $1,100 of prepaid insurance has expired during November. The company originally purchased $240 worth of supplies and recorded it as an asset to be used in the future. During November, $150 worth of supplies were used in operations, leaving a balance of $90. The asset supplies decreases by $150, and retained earnings also decreases to reflect the use of supplies in operations. In addition, supplies expense under the income statement column is recorded as a negative $150. Fixed assets, such as office equipment, lose their ability to provide service over time. This reduction in an asset's ability to provide service is called depreciation. Depreciation is estimated based on the asset's useful life. A record of the original cost of the asset must be maintained for tax and other purposes. A contra asset account is used to accumulate depreciation of an asset over time. This accumulated depreciation is then subtracted from the cost of the fixed asset on the balance sheet. Keep in mind that land is not depreciated because it usually doesn't lose its ability to provide service. The cost of the equipment is a type of deferred expense that is recognized as an expense over the fixed asset's useful life. The cost of the fixed asset less the balance of its accumulated depreciation is called the asset's book value or carrying value. In our example, a monthly depreciation expense is $160. Depreciation is recorded by entering a negative $160 in the accumulated depreciation column and the retained earnings column. Depreciation expense is also reported under the income statement column as negative $160. It is not reported under the statement of cash flows column, as this record does not involve cash. The book value or carrying value is calculated by subtracting the balance in the asset's accumulated depreciation account from the cost of the asset. In this example, it is $8,500 less $160 and equal to $8,340. On November 1st, Family Healthcare had received $1,800 from ILS for rental of land for 5 months. The portion of the revenue earned by the end of November would be 1/5 of $1,800 or $360. Unearned revenue decreases and retained earnings increases by $360. In addition, rent revenue increases by $360 under the income statement column. Accrued expenses or liabilities are expenses that have been incurred but are not yet recorded. An example would be wages incurred during the months, which are unpaid on the last day of the month. Normally, employees are not paid on the same day an accounting period ends. In our example, the amount owed for wages that have not been paid increases the liability account called wages payable by $220. Retained earnings will also decrease by this amount. Wages expense is recorded under the income statement column as a negative $220. Accrued revenues or assets are revenues earned but not yet recorded. An example would be revenue for patient services earned but not yet billed to the insurance companies. Normally, accrued revenue adjustments are used to account for services provided near month's end. This adjustment is recorded by increasing accounts receivable by the amount which will be billed later. In our example, accounts receivable is increased by $750. Retained earnings increases and fees earned is recorded under the income statement column as $750. Thank you for watching this video. Don't forget to like and subscribe. More videos are coming soon.